Hello and welcome to the latest market update with me, Andrew, and today I'm joined again by Dan.
Yes, hello. How are we?
Very well, thanks Dan.
Oh, good.
Good to have you along again. So what we're going to do today is we're going to have a wee chat about the way the markets currently are.
Yeah.
I think you've got one or two questions.
Yeah, so I know that a few people have been saying it's been quite a tumultuous start to 2022, and it's just to see how the markets are performing up to date, just with all the issues that are going around the world just now.
Yes, I think it's very similar to the presentation we did last month, in the inflation, quantitative easing being starting to be reduced as well. I'll talk about it is adding to the market uncertainty, and then of course put into the mix the invasion of the Ukraine. Obviously our thoughts with anybody affected over there in this dreadful time. So we're getting really the sort of continuation of that. The big impact, I think, with the invasion is with Russia being such a large producer of gas stroke oil. And so the challenge at this time of year as well, oil prices are up. Now we're over $100 a barrel as we record this. We got there a few years ago with that price, but then it quickly went down again. So in the winter months, we consume more oil and gas than we do normally in spring, summer. So that's going to have a bit of an impact on the inflation numbers coming through probably for the rest of the year. So I think inflation is going to be a bit of an issue. And in terms of the money markets, this gives them a bit of a challenge, because what you want to make sure is if you're owning assets, those assets generate a decent return above inflation. So when inflation's low, you can perhaps accept slightly lower returns from your assets. When the inflation figures start to increase, they've got to work harder for you. So this is one of the challenge. I suppose perhaps on the opportunity side of things, that the invasion may lead the likes of the Federal Reserve to put off perhaps the quantitative easing slightly for another month or two, just until the world gets into a better position. But I think the good thing this time around with the conflict is the world generally, excluding China, is acting as one, putting packages together against Russia, and will also look to protect the West in terms of economy and growth potential, etc. So I think it's a good position, certainly a lot better than the Gulf War, for example, where the world really didn't act as one, there were different factions there. So I think there is some sort of opportunity to be had.
So you touched on the conflict there. So what do you think of the potential implications long term of that conflict if it was to be drawn out with regards to the markets?
Yes, I think that's the worst of all situations, that it continues to keep going. And probably you're really looking then at inflation because of the oil supply from Russia. You've got to be saying probably there'll come a time when countries will say, right, we've got to embargo Russian oil. Although, again, on the positive front, perhaps the talks are going quite well in Iran. We're getting them back into the international community. They have very large oil reserves, which would be able to be used in these times, which would then aid the market as well. And within America, we've got Joe Biden saying he's probably going to release some of the American oil reserves as well. So the world coming together, trying to sort this out is the major thing, but we want the conflict to be resolved, and resolved as peacefully and quickly as possible.
Yes, so with everything that's going on in the world, conflicts and obviously the oil prices and whatnot, we've seen a couple of negative months with regards to the A.R.D. Consultancy portfolio fund. So when was the last time that ever happened?
Yes, well, thank you, Dan. I think we've got to remember that it's not just the A.R.D. Consultancy portfolios that have experienced 2 months of negative returns.
Around the world,
But actually, that's a very good question. The last time we got 2 consecutive months of negative growth was way back in 2009, which is the end of the end of the financial crisis. And interesting, when we look at that, the last time we got those 2 negative months, then 18 months after that, the balance portfolio, for example, was up 60%. So I'm not saying that's going to happen again, but another interesting fact from then as well was in 2009, when the recovery started, the Bank of England base rate was exactly the same rate it is at the moment. So perhaps if we're looking for some guidance as to what's going to happen in the future, we won't be far off to say, well, okay, so we have times when the market does dip, and this is where, as we keep rabbiting on about every time we do one of these presentations, it's where the profits for the future years are made. Because again, we're seeing that the funds coming in, we're getting more funds coming in than we're actually paying out in terms of withdrawals. So people saying this again as a good buying opportunity. So the graphs I look at, they cover the last 40, 50 years of equity returns. There's very few periods in time when you do get this sort of reduction in values. And as long as the fundamentals are right, so in other words, we've got virtually full employment here in the UK. The US has got very, very good figures. Companies that we've got shares in at the moment, as well as other assets, are declaring really, really good numbers. And a lot of the companies and assets that we have are inflation protected. So they're able to pass on extra costs to the consumer, which means that really when we're looking at a buy opportunity, they don't come much better than just at the moment. I know we always say that, but I think if we just look at what's happening in the world, take out the conflict, which, let's face it, that there are always conflicts in the world one way or the other, then it is quite a good time. But yes, you're right, 2 months in a row for negative returns, which we see as an opportunity rather than something to be worried or alarmed about.
That's definitely a difficult time, I think, for many, just with all the conflict that's going on. I know people are a bit nervous about the situation, but with everything that's going on, what's the outlook? I know you touched on it there, but the outlook in years to come, I guess you have sort of mentioned that already, but what's the outlook for these A.R.D portfolio funds?
I think we're going to find that, again, the higher equity funds are going to pick up very, very well. The lower equity holdings, again, it's going to be a little while before they get adjusted in terms of the returns to inflation. So for the low risk portfolios, which is the defensive stroke cautious, then we're probably going to be looking at, I would say, I don't know, I'm going to put my neck on the line here and say from here to the next year, we're probably looking at about a 4% increase for the defensive and around about 8% for the cautious portfolio. The higher the equity ones, then again, looking back through the history books and seeing what's happened before, I think if we sat here a year's time and we're not seeing good double-digit growth from this period, then I'd be quite surprised.
Great. On the record, Andrew.
Yeah, was it?
Now turning to the performance of the A.R.D consultancy funds over the past 1 month, 1 year, and 5 years. Interestingly, it's the first time we have come across this whereby all the portfolios have shown the same returns for this month, which is in and around -3%. With regards to the cautious portfolio over the year, it's up 1%, 5 years, up 26%. The balanced portfolio over 1 year is up 2%, and over 5 years, up 36%. The capital growth portfolio over the last year is up 4%, and over the last 5 years, 46%. And finally, the aggressive portfolio over the last year is up 6%, and over the last 5 years, up 57%.